If you ever wondered how many rentals you need to retire, maybe even retire early, I'm going to give you a field manual. So let's use some simple math. Two clear examples and a 5-step plan so you know exactly what your number is today. I'm Bud Evans. I help veterans, first responders, and even driven real estate investors build portfolios that create real freedom. By the end of this video, you're going to know exactly how many rentals you need for your target lifestyle and which path gets you there faster. I'm going to keep it simple. We have three variables. E is your annual personal expenses in retirement. R is your cash return that you're going to earn on your real estate. That's going to be your annual percentage from actual cash flow. And W equals your wealth or equity required in the real estate. So formula is E divided by R equals W. Quick check. If you want to earn $70,000 a year and you can earn 10% in cash return, you're going to need $700,000 in equity. If you want $100,000 a year and you expect 6%, you're going to need about $1.66 million in equity. Lower returns mean you're going to need higher equity. Higher expenses mean you need more equity. Simple, right? Okay, assume that you eventually own 10 units free and clear. Each unit costs you 120,000. Total value divided by equity is 1.2 million per unit. Rent $1,200 per month. Operating expenses, that's taxes, insurance, maintenance, management, capital expenses, 500 a month. Your NOI is going to be 700 a month. That's $8,400 per year per 10 units. It's $84,000 pre-tax income. Return on equity is 84,000 divided by 1.2 million or 7%. Why this works? Low risk in retirement, no debt payments if the rents dip. Simple to manage with systems and property management. It can be a true part-time operation. Often a higher income yield than 4% stock withdrawal rules. Trade-off, it takes time to pay off debt in order to have it free and clear. It's slower to build, safer to hold. Assume 28 units here at 120,000 each. That's 3.36 million with a down payment of 30,000 a unit, $840,000 in equity. Your debt's 2.52. Same rent, 1,200 a month, 500 NOI, 700 month mortgage payment, $450 a month cash flow, and $3,000 per year for 28 units is $84,000 a year pre-tax. Same income target as number one. So your return on equity is 10% cash. 840,000 is 10% cash return plus potential equity growth from debt paydown. The upside here is that the lower equity to hit the same income, faster net worth growth when things go right. Downside is refi risk, rental shocks, and operational complexity. Leverage is going to amplify your wins, but it's also going to amplify your losses. The bottom line here is choose the risk profile that fits your temperament and market. You can also blend, pay off some over time and keep some light leverage on others. Now, let's talk about what you're going to do here. Number one, you're going to know today's spend. List your current annual expenses. Use a simple spreadsheet or Rocket Money. You can't hit a target unless you have it defined. Step two is adjust for retirement. Costs are going to go up, right? Healthcare, others go down, no 401k savings taken out, your mortgage is paid off, your kids are out of the house. Add a buffer if you want a margin. This is going to give you E. That's step three. Account for other income. List pensions, Social Security, dividends, business income. Subtract that from your E. The remainder here is the portion of your rentals are going to have to cover. So step four, build a sample property portfolio. In your market, pick a realistic target, unit, price, expected rent, and true operating expenses. Taxes, insurance, maintenance, property management, CapEx. From that, estimate your cash return. That's the R for paid off and or leverage scenarios. Step five, we're going to run the formula and translate it into doors. Use E divided by R equals W. And then ask, at my target property price, how many units equals W? So target retirement spend to be covered by rentals after other income. Let's say it's $80,000 a year. You can reasonably achieve 10% cash return, which is R, with your approach. W is 80,000 divided by 0.10 equals 800,000 in equity required. If your typical property requires $100,000 in equity when it's all paid off in 8 units, you're on leverage and you only need $60,000 in equity per unit to produce the same per unit cash flow. That's 14 units. So pick the path that fits your risk tolerance and timelines. Systems are greater than heroics here. So get property management, maintenance, bookkeeping, and reserves all dialed in. Debt snowball works. I use it. As cash flow grows, attack one loan at a time until key units are paid off. Underwrite for reality. Use conservative rents and real expenses. Don't skip CapEx. Here's your stress test. Ask, if rents drop 10 to 15% or rates rise at refi, will I still survive? Now here's your milestones. Unit 1 is funded. Unit 4 stabilizes expenses. Unit 8 pays X of lifestyle expenses. You don't need a perfect spreadsheet. You need a target and a first move. Run your number tonight. Pick your model, free and clear, leveraged or blended, and commit to the next property. If you want help mapping out your exact plan, do me a favor. Book a quick strategy session over at budevans.com. I'll help you out. It's free. There's no obligation. And if you think this was useful, like, subscribe, and share it with somebody who needs a straight answer on retirement with rentals. Hey, thanks for watching, and until the next video, aim high.